The global market sell-off reflecting a wide array of worries facing investors. One top concern being the health of the U.S. economy and the Federal Reserve potentially being behind in cutting interest rates. To check that pulse on market sentiment, we have former PIMCO CEO, Cambridge Queen's College President, and Allianz Chief Economic Advisor, Mohamed El-Erian, joining us now to discuss. Mohamed, as I said to you in an email earlier, there's almost no one I would rather speak to today to get perspective on what's happening. So I'm really happy you could make the time to speak with us. I want to start with something that you have said to us frequently over at least the past 6 months, if not longer, which is that the longer the Fed waited to cut rates, the higher the chance of something breaking. Is that what we're seeing happen right now?
Thanks for having me, Julie. We're seeing red lights on three things: fundamentals, policy, and technicals. And they are feeding onto each other. And the question is, will they simply run themselves out, or will they result in something even worse? So on the policy side, I've been of the view that the Fed had waited too long. They should have cut, they didn't. And now they're perceived to play catch up. And it's incredible to hear people calling from an intermeeting cut. That is quite amazing that that's what some people want to see. It's not going to happen, but that's what some people want to see. Why is this of concern? Because the economy has been slowing faster than the Fed and others have been anticipating. That's the red light on fundamentals. And then you get the technicals, the unwinding of levered position, including out of Japan. So what we're living through right now are these three blinking red lights, and we need them to turn yellow and then green.
Mohamed, I'm curious because I was talking to Joe Brusuelis, economist over at RSM. He was making the case, Mohamed, to me that, listen, if what we're seeing continues like this and we got another flat reading in the CPI or PCE, then he did think an intermeeting cut, and a supersized one, by the way, 50, would be on the table. You seem skeptical, Mohamed. Why are you skeptical?
Because I think that would signal panic. It would signal total panic. You normally get those sorts of cuts when there's a major exogenous negative shock. When, for example, you have the pandemic, when you have Lehman failing, when you have something that comes from nowhere. What we're seeing here is simply an economic slowdown and a Fed that's behind. For it then to do an emergency cut would give the completely wrong signal to the marketplace. And in fact, it could contribute to a recession because people could get more worried and spend less. And that's what we need to avoid, this self-reinforcing negative spiral.
Well, as it is, with the economy slowing, as you probably heard, we've heard from some folks who are saying we are already in recession or we're close to it. I'm curious to get your take on that. And if we are at least close to a recession, where is that slowing coming from? And I think of, recent past recessions, obviously the pandemic precipitating event, the housing crisis and subprime crisis for the precipitating event for the financial crisis. But what is that thing this time around?
So, Julie, as you know, from months ago, at the beginning of the year, I put the probability of recession at 35%. It is not dominant. It's not over 50%, but it is a fat tail. What was I worried about? Two things: the lower income part of the household distribution and small businesses. They were already under pressure. On the household side, pandemic savings ran out. Credit cards had been maxed out. And all they could rely on now is labor income. So if anything happened to employment, that segment was very vulnerable. Small businesses had also run down their cash balances and were finding borrowing costs very high. Now, people responded saying, you over-worry. It's nowhere near 35%. It's more like 10% because this is a K-shaped economy. Yes, the lower part of the distribution is doing badly, but the other part is doing fine. So on average, everything is fine. What we've discovered is that the weakness is migrating up. And that's what the employment report told us. That's what the ISM employment index told us.
I'm curious, Matt, for investors who are watching right now and they see the reaction in these markets, and they're trying to gauge what comes next. What should they be watching, Mohamed? Are they watching the yen? Are they watching the bond markets? What are you watching?
I'm watching market technicals. I think we are in overshot territory in several segments of the marketplace already, certainly in fixed income in terms of government bond yields. The sort of declines we've seen, especially at the front end of the curve, are, in my view, an overreaction. So look at whether this overreaction starts getting corrected or not. The ISM service number today reminded people that the economy is not completely in recession. It's a risk of recession, not in recession. So look at that. You need to see the technicals stop feeding onto each other.
And when we spoke with Ed Yardeni earlier, and I also saw this in a Wall Street Journal column from James McIntosh today, excuse me, they were comparing this to 1987, right, where you see a Black Monday event, but that wasn't, in fact, followed by a recession, not for a few years. And we sort of had a technical snapback after that. Is that the best sort of analogy for what we're seeing?
Yes, if we can find an anchor. So the big difference with 87 and today is that the Fed was not an amplifier of volatility. The Fed was a stabilizer. Today, unfortunately, because the Fed became so backward-looking and the Fed lost a lot of credibility in the last few years, they've become an amplifier of volatility. And the way you get back to an 87 scenario is by the Fed regaining control of the narrative and the Fed making their forward policy guidance more effective and taken more seriously. Right now, the markets truly believe they can bully the Fed into doing whatever the markets want.
How does the Fed do what you're describing, Mohamed? I mean, obviously we have Jackson Hole, but that's several weeks from now, which feels like a long time in these markets. Is it about, and we don't have a lot of Fed speak on the calendar, there is some. So how do they retake control of that narrative?
Well, I think Austin Goolsbee today, the president of the Chicago Fed, was quite effective. And he did act as a mini circuit breaker in the morning at a really critical time when the fix was out of control and there was a lot of fear in the marketplace. Importantly is to take advantage of Jackson Hole. There's a number of things that are forward-looking that the Fed needs to share their thinking. Things as basic as what do they think the neutral interest rate is? That's really important. Unless you give guidance to the marketplace and stop this excessive data dependence, the Fed ends up being the amplifier of volatility. And that's what we don't need a central bank for that. The markets can contribute to volatility all on their own. They don't need the central bank to amplify it for them.
Mohamed, another issue I've heard raised, and so I just want your take, is whether you think politics is playing any kind of role in the nervousness and the selling, Mohamed, and the idea being, listen, we have an election, the polls show now it's basically a dead heat. Do you think that is an issue that plays any kind of role, Mohamed?
So I had this image of Family Feud. You're too young, but you put up what the main factors are. So politics, domestic politics is fifth. The first one is a growth scare, then concerns about a policy mistake, then the bad technicals, then geopolitics and the possibility of an escalation of the Middle East war, and then finally it's domestic politics. So is it there? Yes, but its influence is very small compared to the other four.
If only we were too young for Family Feud, Mohamed. I feel like I should be hitting a buzzer even just hearing that phrase. Mohamed El-Erian, always a pleasure. Thank you very much.
Thank you for having me.